Unshakeable, Your Financial Freedom Playbook by Tony Robbins is a book that will teach you how to remain unshakable on your journey towards financial independence by presenting facts and principles that most successful investors use. In this video, we'll go through the key points from Unshakeable. But before we do, feel free to leave a like on the video, as every like, share and comment help the channel out tremendously and I really appreciate it. If you're new here, feel free to subscribe with the notifications turned on for more personal finance, investing, business and motivational related videos, as well as weekly book summaries. Takeaway number 1. How to achieve financial freedom. Many people believe in the common misconception that earning a lot of money is all you need to become financially free. That's however not true, cause you'll never earn your way to true financial freedom. The real road to becoming wealthy instead lies in setting aside a portion of your income whenever you receive it, investing it and letting it compound over many years. This is how your money makes you money while you sleep and how you can achieve true financial freedom. The number that the author recommends you aim for is 20 times your income if you want total financial independence, while covering your necessary expenses only requires about 12 times your income. Now, this may seem like an overwhelmingly big number, but it's not that high actually, especially when you account for the compounding that can help you reach it faster. Every journey starts with a single step, and setting up automatic deductions can be that step for you. You can start with as low as 3% of your income and gradually increase the deductions up to 15 or even 20% over time to build your freedom fund faster. Over the last 200 years, the stock market has been the best wealth building tool, and you can also use it to get rich. Takeaway number 2. Freedom facts. Many people have a great fear of investing in the market because of its volatile nature, but there is really no reason to worry, as both corrections and bear markets are part of the journey. We should not fear them, we should just accept them for what they are, small bumps in the road. After every single bear market, a bull market appeared and the market always recovered. These freedom facts will help you better understand why the biggest danger isn't a correction or a bear market, but being out of the market instead. A quick reminder, when the market falls by at least 10% from its peak, that's called a correction, and when it falls by at least 20% from its peak, that's called a bear market. Freedom fact number 1. On average, corrections have occurred about once a year since 1900. Freedom fact number 2. Less than 20% of all corrections turn into a bear market. Freedom fact number 3. Nobody can predict consistently whether the market will rise or fall. Freedom fact number 4. The stock market rises over time despite many short-term setbacks. Freedom fact number 5. Historically, bear markets have happened every 3 to 5 years. Freedom fact number 6. Bear markets become bull markets and pessimism becomes optimism. Freedom fact number 7. The greatest danger is being out of the market. Look, it's simply impossible to jump in and out of the market successfully. You would have to time both the peak and the bottom perfectly every time. And missing out on just a few days would ruin your returns so much that you would end up underperforming the market. Remember that time in the market beats timing the market. Takeaway number 3. Advisors and salesmen. More than 40% of Americans use an advisor, and it turns out that the more money you have, the more likely you are to seek out advice. Over 80% of people with net worth of over $5 million have an advisor. Now the problem here is that many advisors are simply not looking after your best interest. 90% of financial advisors in America are actually just brokers. They're paid to sell financial products to customers in return for a fee, and that's what their quote-unquote advice is focused around. All financial advisors fall into just one of these 3 categories. A broker, meaning that they're paid a fee or a commission for selling products. They don't have to recommend you the best product, and they and their employers earn more if they can convince you to buy certain products. A registered investment advisor. They have a fiduciary duty and a legal obligation to act in their client's best interest at all times. They don't accept sales commissions, but instead typically charge either a flat fee for financial advice or a percentage of their client's assets under management. Or a duly registered advisor. They are registered both as fiduciaries and as brokers, letting them play the part of an independent advisor, reassuring you that they must abide by their fiduciary standard, and a second later just switch heads and act as a broker, earning commissions by selling you products. Now, obviously, somebody who is only an independent advisor will probably be your best bet, but you also need to find someone who is financially sophisticated and highly skilled enough to be a good advisor. Takeaway number 4. Core investing principles. These are the 4 major principles that nearly all great investors use to guide them in making investment decisions and can be very powerful influence in your ability to achieve financial freedom. But bear in mind that you also have to practice them, as execution is everything. Core principle number 1. Don't lose. Always look for a way to reduce your risks and maximize your rewards. Expect the unexpected, but always try to invest in a way that helps protect you from nasty surprises. Core principle number 2. Asymmetric risk and reward. Most people think that you need to take big risks to achieve big returns, but there are investment opportunities with low downside but huge upside potential hiding around, and the best investors always look out for such deals. Core principle number 3. Tax efficiency. Taxes have the potential to eat up a huge amount of your investments. That's why avoiding mutual funds and focusing on buying and holding index funds over long periods of time is generally a very good idea. Before making any investment, try asking yourself, how tax efficient is this going to be, and is there any way I could make this even more tax efficient? Core principle number 4. Diversification. There are 4 important ways to diversify effectively. Diversify across different asset classes, diversify within asset classes, diversify across markets, countries, and currencies around the world, and diversify across time. Basically, everything boils down to the idea of owning an array of assets that don't always move with one another. Takeaway number 5. How to slay the bear. Let's learn how to prepare for and profit from a bear market. It all revolves around building a diversified portfolio, a position that's conservative enough, standing your ground, and slaying the bear while others run away in fear. You have to remember that based on more than a century of history, while the short-term outlook may look dire, the stock market always rebounds in the long term. Now, everyone is in a different situation and has different goals, so there is no one-size-fits-all approach. Everyone needs a customized solution to help them achieve their own goals. Here are some of the most important tips for you to build your own portfolio. Asset allocation drives returns, so deciding on the right balance of stocks, bonds, and alternative investments such as real estate investment trusts, private equity funds, master limited partnerships or MLPs, and gold is the most important investment decision you'll ever make. Use index funds for the core of your portfolio. Indexing gives you the long-term upward trajectory of the market without letting expenses and taxes corrode your returns. Always have a cushion. You never want to end up in a position where you'll be forced to sell your stocks at the market bottom, so it makes sense to maintain a financial cushion at all times. The rule of 7. The authors recommend having up to 7 years of income set aside in income-producing investments such as bonds and MLPs, so in case of a stock market crash, you can use these income-producing assets to meet your short-term needs. Explore. It can make sense to explore additional strategies that offer a reasonable chance of outperformance, such as low-risk, high-reward deals. Rebalance. It's important to bring your portfolio back to your original asset allocation on a regular basis, for example once a year. This will make you sell high and buy low by default. Takeaway number 6. How to silence the enemy within. There is one more enemy that could mess up your journey towards financial freedom, and that is you. Yes, you are the single biggest threat to your financial well-being, or more specifically your brain. But here are some of the most common mistakes that create the most damage on your road to financial independence and the ways we can avoid them. Mistake number 1. Seeking confirmation of your beliefs. Confirmation bias is the human tendency to seek out and value information that confirms our own perceptions and beliefs. It also leads us to avoid, undervalue, or disregard any information that conflicts with our beliefs, making it very dangerous while investing. The solution? Ask better questions and find qualified people who disagree with you. Mistake number 2. Mistaking recent events for ongoing trends. One of the most dangerous investing mistakes is the belief that the current trend will continue, and when the investor's expectations aren't met, they often end up overreacting, which leads to a dramatic reversal of the trend. The solution? Don't sell out, rebalance. Mistake number 3. Overestimating our abilities and our knowledge. By admitting to yourself that you don't have any special advantage, you give yourself an enormous advantage because you'll do so much better than all the investors who delude themselves into believing they can outperform. The solution? Get real, get honest. Mistake 4. Greed, gambling, and a quest for home runs. The best way to win the game of investing is to achieve sustainable long-term returns. But we all know it's tempting to try to swing for home runs, especially when it seems like other people are getting rich far faster than us. The solution? It's a marathon, not a sprint. Mistake number 5. Staying home. When it comes to investing, people often tend to stick with whatever they know best, and this leads them to invest disproportionately in their own country's markets, their employer's stock, and/or their own industry. The solution? Expand your horizons. Mistake number 6. Negativity and loss aversion. Human beings have a natural tendency to recall negative experiences way better than they do positive ones. In turn, financial losses cause people twice as much pain as the pleasure they receive from financial gains. This is known as loss aversion. The solution? Preparation is key. To summarize, how to achieve financial freedom. The real road to becoming wealthy lies in setting aside a portion of your income whenever you receive it, investing it, and letting it compound over many years. This is how your money makes you money while you sleep and how you can achieve true financial freedom. Freedom facts. Freedom fact number 1. On average, corrections have occurred about once a year since 1900. Fact 2. Less than 20% of all corrections turn into a bear market. Fact 3. Nobody can predict consistently whether the market will rise or fall. Fact 4. The stock market rises over time despite many short-term setbacks. Fact 5. Historically, bear markets have happened every 3 to 5 years. Fact 6. Bear markets become bull markets and pessimism becomes optimism. Fact 7. The greatest danger is being out of the market. Advisors versus salesmen. All financial advisors fall into one of these 3 categories. A broker that's paid a fee or a commission for selling products. A registered investment advisor that has a fiduciary duty and legal obligation to act in their client's best interest at all times. Or a duly registered advisor that is registered as both fiduciary and a broker. Core investing principles. Core principle number 1. Don't lose. Principle 2. Asymmetric risk and reward. Principle 3. Tax efficiency. Principle 4. Diversification. How to slay the bear. Here are some of the most important tips for you to build your own portfolio. Asset allocation drives returns. Use index funds for the core of your portfolio. Always have a cushion. Apply the rule of 7. Explore and rebalance. How to silence the enemy within. Here are some of the most common mistakes that create the most damage on your road to financial independence, and the ways you can avoid them. Mistake number 1. Seeking confirmation of your beliefs. The solution? Ask better questions and find qualified people who disagree with you. Mistake number 2. Mistaking recent events for ongoing trends. The solution? Don't sell out, rebalance. Mistake 3. Overestimating your abilities and your knowledge. The solution? Get real, get honest. Mistake 4. Greed, gambling, and a quest for home runs. The solution? It's a marathon, not a sprint. Mistake 5. Staying home. The solution? Expand your horizons. Mistake 6. Negativity and loss aversion. The solution? Preparation is the key. Thank you for watching, and I really hope this video was useful to you. As a final note, let me clarify that this is a summary of a book. It is not investment advice nor my personal opinion. You must always do your own due diligence before investing, as it's your money and you and only you are responsible for the consequences of your own actions. With that out of the way, thank you all for sharing the videos with friends and of course destroying the like button. There's much more investing, personal finance, business and motivation related content on the way, as well as weekly book summaries, so feel free to subscribe if you are not done so yet. I'll see you in the comment section below, so enjoy the rest of your day. Bye bye!